A credit card's minimum payment can make thousands of dollars of debt look manageable. That is exactly why it can be dangerous. Paying the minimum may keep the account from becoming delinquent, but it can also keep you in debt far longer than most people expect. The minimum payment is the smallest amount your issuer requires for that billing cycle. The formula varies by company and account. It may be a percentage of the balance, a fixed dollar amount, or a calculation that includes interest, fees, and part of the principal. Principal is the amount of debt itself, before future interest. Here is a simplified example. Suppose you owe $3,000 on a credit card with a 24% APR and make no new purchases. 24% per year is roughly 2% per month, although actual credit card interest is commonly calculated using a daily periodic rate. At the beginning, 1 month of interest could be close to $60. If your payment were $90, roughly $60 might cover interest, and only about $30 might reduce the original balance. The exact numbers would depend on the issuer's method, the number of days in the billing cycle, payment timing, and any fees. This creates the minimum payment trap. You send money every month, but the balance falls slowly because interest consumes part of each payment. Minimum payments may also decline as the balance falls. That sounds helpful, but smaller payments can extend repayment even further. Federal credit card rules require periodic statements to include minimum payment disclosures in most situations. Your statement may estimate how long repayment would take and how much you could pay in total if you make only the minimum and add no new charges. It may also show the monthly payment needed to repay the balance in approximately 3 years. These estimates are worth reading because they turn an abstract interest rate into a real cost and timeline. Consider the behavior that makes the problem worse. A cardholder pays $100 but charges another $150 before the next statement. Even though a payment was made, the balance may rise. It is difficult to repay revolving debt while continuing to use the same account for expenses the budget cannot cover. Carrying a balance can also affect new purchases. Many credit cards offer a grace period when the statement balance is paid in full. If you carry an unpaid balance, you may lose that grace period depending on the card's terms. New purchases can then begin generating interest instead of remaining interest-free until the next due date. Balance transfers can create a similar complication. A 0% transfer offer does not necessarily mean new purchases receive 0% financing. A balance transfer moves debt from one card to another, usually in exchange for a fee. The promotional APR lasts for a limited period. This can reduce interest when the fee is reasonable and the transferred balance is repaid before the promotion ends, but it does not erase the debt. Approval, the available limit, and the promotional terms depend on the issuer and the applicant's credit profile. If spending continues, someone can end up with debt on both cards. There are 2 common repayment strategies. The debt avalanche method directs extra money toward the balance with the highest interest rate, while minimum payments continue on the others. This generally minimizes interest. The debt snowball method targets the smallest balance first, which can provide quicker progress and motivation. The mathematically cheaper method is not always the behaviorally easiest one, so consistency matters. A practical repayment plan starts by listing every card's balance, APR, minimum payment, and due date. Stop adding non-essential charges. Make every minimum payment on time, then direct all available extra money toward one target card. When that card is paid off, roll its former payment into the next balance. Even modest extra payments can reduce the repayment period because more principal disappears sooner and less remains available to generate interest. It is also important to build a small emergency buffer. Without any cash reserve, an unexpected car repair or medical bill can send new charges back onto the card. At the same time, avoid draining money needed for housing, food, utilities, transportation, insurance, or other essential obligations simply to make an aggressive payment. What should you watch next? Check whether your APR is fixed or variable, whether a promotional rate is expiring, whether your issuer charges a balance transfer fee, and whether your statement shows a payoff estimate. If you are struggling to make even the minimum, contact the issuer before missing payments and ask whether hardship options are available. A reputable nonprofit credit counselor may also help you review a repayment plan. The main lesson is that the minimum payment is a requirement, not a financial goal. Paying more than the minimum reduces principal faster, lowers future interest, and moves you toward becoming debt-free. This video is for informational and educational purposes only and is not financial, legal, or investment advice. Consider your individual circumstances and review the terms of each account before making financial decisions.